After several revisions, Xstrata's board of directors finally recommended that its shareholders vote in favor of Glencore's revised merger proposal. Spanish Prime Minister Mariano Rajoy said over the weekend that the country's budget deficit would widen because of the need to help shore up their banks. I'm Lindsey Bell, and the morning call starts right now.
Good morning, I'm Scott Redler, Chief Strategic Officer of T3Live.com.
And I'm Lindsey Bell with TheStreet, and together we bring you the morning call. We saw the third quarter end in positive territory. The S&P was up 6% almost for the quarter. Now that was despite some weakness at the end of the quarter, but looking towards today, the fourth quarter looks like we're going to kick it off with a positive tone.
Right, so 6% last quarter. I think the S&P is up like 16% plus for the year. Nasdaq's up 18% plus for the year. A lot to like in the equity space. The last 2-year run has been pretty impressive as well. So even though we've had some choppy / sloppy type action the last week or two, there's still a lot to like. Just the question is, what type of fourth quarter are we going to have?
You know, we are seeing new money flow into the market because it is the beginning of the quarter, but are people going to sell on that flow?
Well, that's what we're going to look for. For short term, it's very important. So if we take a look at the chart of the S&P, I want to show you, first of all, since we're almost near our anniversary, you guys remember this? This was October 4th, not even a year ago. A year ago, we were looking to break below 1100. It looked as if the world was going to end. And we actually had a lot of the same problems we have now, but they started to develop a framework for all of them. And anyway, market action changed on this day. From here, I like to talk about different patterns that take place over the course of a year, patterns that you can navigate. First one was after this reversal low here, went as high as almost 1300. Then what we consolidated. We created a wedge type pattern. From here, you had your first quarter advance. It was great. You could have held 10, 15, 18 stocks with some hedges along the way. And then, like any move, look where we came from 1100 all the way up to almost 1400. Then we had the head and shoulders top pattern put in place. Here's when it broke that neckline around 1360. So if you wanted to lighten up on stock, maybe start trading from a net short position, you saved yourself about 100 handles to the downside. Then June 4th, another low. This is like the last pattern that's been controlling this move. We've had two different trends all the way up with this cup and handle pattern in the mix. So coming into where we are now on a short-term basis, because a lot of us do trade short-term, here's what's important. The high here is 1474. We got into a very choppy range right in here as we were extended from the 8 and the 21-day moving average. So finally we broke below 1449. This is when a lot of intermediate traders, including myself, took some risk off, cleaned up some excessive positions because who knew where we were going to go. Anyway, if you're 1449, we went as low as 1430 Wednesday. We now have this lower pivot right here. I would say, guys are watching 1450. If the bulls could reclaim 1450 with some volume, with a little bit of conviction, I do think the highs of the year gets taken out pretty quick. But if, like you said, new money comes in, like it does in the first day of a month, and all of a sudden it gets sold or they sell into it, and we go from up 5 handles and we have a red day, you'll know that people are looking to sell, and we might have some more downside probing, but overall a very macro, intensive environment that looks okay.
Yeah, the macro certainly looks okay. Going into the sector spotlight, we're going to take a look at retail, which was one of the stronger sectors this year. We'll specifically look at the value retailers like the dollar stores who have done well over the last year or so, partially because of the high unemployment and slow wage growth, but also because of what they've been doing to revamp their stores and bring new products like grocery products into their stores. They're bringing more people in. We'll start with Dollar General. This is a stock that Stephanie Link was buying last week after she saw weakness on the secondary offering, which was priced at $51.75. One of their largest shareholders, basically KKR, was reducing their share, which is a positive for the company. She likes the fundamentals, but is this a stock that you could trade? Typically, the stock will rise 6% the week after a secondary offering.
Yeah, well, once you have a secondary, you get a lot of stock out of the way. There's some emotions that flow back and forth for people who traded it before or after. So typically, things do go higher because then that stock should be in hands that were placed for safety measures or for people who wanted the stock. So anyway, you look at the chart as far as the technical pattern here. Right here is when it looked like it was breaking the downtrend that was in place since July. broke above it, flagged, and then basically, didn't have the momentum like most things in the market to continue. So it broke below, came back, retested. I think into this 51 area, as long as 51, or that secondary price holds, I think that you'll see some commitment to this. So right here on a short-term basis, I'd like to see this 51 or 51.50 hold, and then it's going to have to start taking out this resistance, which will pose a little bit of a problem because you had 4 days of it, and that's right around 53.
Let's take a look at Family Dollar also. This name is kind of lagged Dollar General, but has done really well over the last year. They have earnings on Wednesday. Earlier this year, April, we saw them break out and get up to $75, but it's been kind of on a downtrend since then. So what do you do? What levels do you watch here?
Well, we said earnings are on Wednesday. It just started to break out of a tight pattern. So I think I actually heard some traders talking about it because it was on the move. We typically don't like to take stocks into earnings if you're an investor. Depending on when you bought it, you have to figure out your plan. But if you look at the chart here, it did start to wake up. You had the high that was put in June. It's been slowly just churning to the downside. It just reclaimed the 50 and the 21 day. Broke above it, held above it. So right now I think it's acting a bit better. It is a laggard type play. This isn't a leadership stock right here. So you have to really like the fundamental story if you're going to be there. But I would say above 66.58, next real level of resistance doesn't come until about 70, but you're probably going to have to hold through earnings if you want to experience some kind of move like that.
Walmart is your retail stock of the year. It's been consolidating in the $71 to $75 range. Where do you think it can end the year?
Well, that will help us give clues to where we go in the fourth quarter, because a lot of these stocks, like a Walmart, they've had huge moves. So the question is, what's left in the tank? Are they going to continue? Is it going to correct? Because right now, if you close the books on Walmart, it had a tremendous year. In December, we called it our retail stock of the year because of the tight 9-year channel, for it to break above 62 for a 75 price target. And if you look at it now, okay, it met that earlier. Look, this is where you bought it when it crossed its descending trend line. Here's that gap that never even wanted to get filled. Exciting move, consolidated, went again. And since then, it's been a little bit choppy here. Okay, it's still above the 50. It's below the 8 and 21. It didn't have enough juice to break above. I was actually trying to play this for a momentum move. It didn't have the juice yet. But overall, look at the size of the move. So if Walmart closed today right here, hell of a year. At this particular point, short term, I think if it can go sideways and stay above, just say 73, and the market wants to run at the end of the year, you'll see some traders get back involved for a move to, clear this 75. But for right now, it's still going sideways. It's still choppy. If you're an investor being tier one, if you're looking for a trade, I would still wait.
Retailers had a little pullback last week with the market. And Target was one that we saw. It took back its 8 and 21 days, below those now. So how low can this go?
Well, it shows you that entries and exits are key still. You still can't just throw a dart and think that you can make money. I don't care what anyone says. And Target, even though it's had a great year, there are times to buy it and times to back off and just be in a little less. And if you look here at the chart of Target, last time we really started talking about it was right here in this big wedge. Okay, this was coming into July before it broke out. And then I remember we talked about it again right here on this nice descending little channel. And since then, it's been going up methodically. Now, when I was having a portfolio approach in August, or the beginning of September, I'm like, let me see if I could continue with Target here. It just had a nice consolidation. It was having a very full or a hard time breaking out. So I remember on this day is when I got flat, because I'm here for momentum. Stocks have to be on the move for me to stay with them. Otherwise, I could always re-enter. So it just broke this small ascending channel, not with a lot of velocity, but it did hold the 50-day. So at this particular point, here's your new little channel. As long as it stays above, just say this, 62.99 area, I think that it's fine. But if it starts to break below that, you could see some more downside action to retest this last breakout. And at this point, again, momentum is hard to find. So if you're trying to find a stock to break out above all levels, I would think twice, because a stock like Walmart can't do it, Target can't do it. You're seeing some type of lack of momentum in other places. So it's more of a time to be light, stay with it, but don't get too heavy unless you see some type of pattern take place or new composure anyway.
More action. Costco is a similar story to Target. They broke down past the 8 and 21 day too. Is this a place to enter, or you need to see more action?
I think again, macro, intermediate, micro. Where are you? And for Costco, I've gotten excited about it 3-4 times during the course of this recent run based on patterns. And then when you get to the top ends of ranges, you have to measure your commitment. And to this one, if you look here at Costco, it's on a macro level. Look where it came from. Look where it's pulled back from. This is not a big deal unless you're a short-term trader. This was, we talked about a lot of these flag type patterns. Remember this pattern here when it broke to the upside? Then you had a flag, broke up to the upside. Flag, went to the upside. Here it needed more time before going again. And then, at this particular point, it could have tried again and tried to flag, but this time it broke down from it instead of to the upside. So I would say at this point, if you're a macro investor, stay in tier 1. If you're looking to buy, dip, and enter, I think that this 97.89 would be a great spot. But as of right now, your new pivot low to trade against would be Friday's low, which is right here. But right now, nothing for really a trader to grab onto. But as an investor, it still looks good just being a little less. Because when stocks start to give up their 8-day, their 21-day, that means they need a rest, and the momentum just isn't there. So you don't have a macro investment and a momentum investment, just a macro, so stay in tier 1.
Yeah, we got retail sales coming up on Thursday too, so it's going to be interesting to see how those stocks react to that. But let's take a quick commercial break and we're going to get back into it right after this.
Hi, I'm Scott Redler, Chief Strategic Officer for T3 Live, and I would like to invite you to join us on October 6th and 7th in New York City for our first annual T3 Live Active Trader Super Conference. The 2-day event will focus on what we believe to be the 5 keys to being a successful trader. We will teach you the strategies, tactics, and mindset we take to the market every single day, and you will leave the Super Conference with a personal step-by-step success blueprint. Visit t3live.com and click on the education tab on the top of the page and watch preview videos of this event. Seats will fill up quickly, so be sure to reserve yours today. My colleagues and I look forward to meeting you. Have a great day.
Welcome back. We're going to get into the trenches with some tech and social media stocks. We'll start with Facebook, the giant of social media. This stock had a nice move on Friday. It was up 7% in a weak market. They announced news that they are committed to revenue. They're trying this new gift program where you could buy gifts for other members. So investors rewarded them, getting excited about the revenue potential. How do you set up trading, though, today after that pop?
Well, here's the thing. Facebook, obviously the whipping boy of everybody ever since it came public. There's been, a small amount of times that you could be in it and it's rewarded you. I remember last Monday coming in here, I was actually long trying to trail a position when Barron's put on the front cover saying 15. That day it got hit pretty hard. And then on Friday, when it gapped up on the news that they could have this gift program, it traded well. So a lot of guys re-entered it. I know I used it for an active trade. I just didn't stay with it. But if you look at the overall chart of Facebook, it's still somewhat constructive. Here is the low that was put in place, the day after is when they came out and said Zuckerberg's going to hang out for a year. If you guys remember, this is when it started acting better. We started to buy it when it cleared, or at least I did, when it cleared 1920. And then it had a nice move all the way and was flagging right here before that Barron's article, and pow, brought it in. But if you look at it overall, here's your low, higher low, another higher low. It held a big portion of the gap. So I remember talking about seeing whether or not it could stay above this gap to keep some kind of pent-up momentum in here, which it did. And then it did open up on Friday, close strong. At this point, I think it's up a little bit this morning, trying to fill the gap from last week. So I would say as long as it stays above, just say 21.95, you'll see some short-term money. Stay with it. It closes the gap here at 22.60, and if it does close well today, then all of a sudden, we're going to have another new little point of reference to trade against, which is the highs right here, and then you have the gap from last quarter earnings. So I think this all comes right into play right when it will report, and that's in a few weeks from now. So right now, I would say a B plus a little bit right now from the short-term trading end of it, where you could stay with it.
Okay, LinkedIn, this one's a little more of a favorite in the social media space. It's been holding its 21-day moving average, but it seems like it's kind of a battle between the bulls and the bears here. Who's going to win?
Well, at this point, we talked about macro potential investments besides just a trade, and LinkedIn's been a trade and a macro investment. Peaked out at 125, a few weeks ago, but just like the market's lost some momentum. So when that happens, some momentum names, because LinkedIn's turning into a quality macro and a momentum name, it's going to wait around. So, I think guys like myself got stopped out when it broke back below like 122, 121. It's because we could give it more time to re-enter. It did hold the 21-day, and if you look at the chart overall, it looks fine. You go to the, to the more macro look at it, and look where it is. It's hovering, in the top end of the range. If this is the bottom end, if this is where the previous high was, and this is where it broke out from recently, look where it is. So overall, it's just a little bit sloppy here, building a high-level channel. So at this point, you want to take a close-up look at it here. You will see that it's above the 21-day. It bounced back up. This was that harsh day that got a lot of us out of it. And at some point, momentum guys will get excited again if it can get above 124.60, 125 for investors. Stay the course. This is just choppy action for you. I would, again, say tier 1 like most things. I think right now everything's a tier 1 because that actionable momentum extra tier is just not there right now.
Now, Apple's been a great macro play for a lot of people this year, too. But it's been choppy more recently. It's kind of lost some of its momentum here, and it had a big move to the downside on Friday. So how do you trade this one? Do you go short?
I think traders are making money being a cute short here too.
Yeah.
I would say if you look at the chart, ever since last quarter's earnings, I've been pretty much net long it. I'm typically 80–90% net long it, but
yeah.
I've been trying to hold it longer. So if you look here, this is when they reported their earnings, and since then you had a few nice swing trades. Once when it went into the gap, real quick and held it. We went over this chart in the blog. Then you had another nice entry above 620. Then when it went above 644, so it was on a nice path from here all the way to 700. And then at 700, you always have a little bit of trouble, but then also put that in with, how many, phones, how many iPhone 5 phones are coming out, the supply chain disruptions that they're talking about, or even just the lack of love for this iPhone 5. But anyway, so what I did is I started to break it down, and I said, okay, I'm not going to just be holding this long because guys are making some money short it too, and I could be quick. So on this day, it broke the 21-day moving average. So this is when I got stopped out of my, commitment stock around 683. And then came in, tested this support line, and this is when we had the red dog reversal. It was a really nice day, really nice trade on Wednesday, okay, or actually, no, I'm sorry, Thursday. But then, I held some, and right away, in the first, half an hour on Friday, it gave back more than a third. Strong stocks that want to show commitment to a day like this should not give back more than a third. This actually gave back more than a half. So to me, I'm like, you know what? I'm going to start just trading it back and forth. And macro investors obviously do a lot better long this thing, and I think you stay long. But for a trader, I'm going to be a little bit more flexible over the next week or so, or at least until earnings. Here you have 660, 675. We start getting below that. You have a 2-day pivot here between 660 and 661. So I would say, here is this line in the sand, and if it starts to break below it and continues to show some weakness, the 50-day is right here at 650, and then that, breakout area from the old 52-week high comes into play at 644. So overall, if you're a macro investor, you're doing really, really well. As a trader, though, I think that riding this trend that we had a great time riding between August and September, now's the time to just take 2-way trades and be a little bit lighter on your feet.
Now let's just look at one of the suppliers to the iPhone. We got Broadcom. They won actually share in the iPhone. They've got now not just the combo chip, but they have another chip that's part of the touchscreen for the user. But this stock sold off after the iPhone was released, as did a lot of the suppliers. I think they run up in going into the release and then sell off a little bit. So is there a trade in this one, maybe to the downside, current near term?
Yeah, well, if Apple doesn't hold 666 or break 660, you're going to see the suppliers get hit.
Yep.
And this one has been somewhat of a, I wouldn't say a broken stock all year, but you've had to be so tactical. This stock didn't make 52-week highs. It hasn't been a momentum play. It's just been a tactical trade into key areas. But, the semis have also been very weak. You look at the SMHs, they've just been a problem because most of the semis are all in the more PC-centric type of areas, and we all know that PC group is not the place to be. It's been in handheld. So you go to Broadcom, which focuses a lot on handheld. Here is the low that came in July. Gave you a move back up, this ascending channel, then just broke to the downside. It gave way to the 8 to 21. It's trying to hold the 50. So right here, watch this smaller wedge develop. Okay, if it can't get back above this little trend line here and Apple breaks to the downside, you will see some people try and short Broadcom around 34. If it could hold and repair and Apple repairs, then maybe it goes up. But if you look at the overall chart of Broadcom for the year, hasn't really been a great stock. Since the lows it was okay, but it's not like it's a stock making 52-week highs, going nuts. But if you look at the semis, look at the SMHs, they too, you know, it made a much lower high here, like where the markets were making higher highs. You know, it stopped at resistance and it's below all the moving averages, and rightly so, because the semiconductors are trying to figure out what their next move is as the PC sector is slowing down versus handheld, which is you know, the place to be.
Exactly. Let's do some quick hits. We'll start with LVS. This stock broke out on Tuesday and has been consolidating since then. Is there a trade to find here?
Yes, LVS, I would just say 47.38. Above that, traders will start getting excited again.
How about WYNN?
WYNN also looking a little bit better. Let's take a quick look at this chart. You know, it definitely got very beat up this year, but ever since LVS put its low in July, this has been acting better. It now has a nice little flag type pattern here. I've been watching it the last few days. In order for it to get going, it has to trade above 116.5 and hold it. So this is on my radar.
Goldman was out, Barron's was out this weekend with a positive article. It's opening up in positive tone this morning. What do you see in the stock?
It'll be interesting to watch because this stock has given us some leadership, has had a leadership role, and Goldman lacked that for a while already. But recently, it re-energized. It helped fuel a bank move, and then you know it also gave us clues when we topped on September 14th that it was ready for a correction. So now it had a controlled pullback. I would say at this particular point, you know, remember this breakout. This is what led the banks, and then you had the doji top, which gave us a cute short. I think it's pulled in, held decently. You now have like a little downtrend coming into play. This will give us clues for the market. If it could go, and I would say if it could get above and stay above 116, 116.5 and get above this area, you know, you will see the banks try and get back in motion. So right now, you know, let's see if we get a feeble bounce to turn lower or we reclaim this 116-ish area. And if we reclaim 116-ish, you're going to see some of the other banks get stronger, and then maybe we build upon this five-handle up open.
All right, well, that's all we have time for. So those are the stocks we're watching, the sectors we're looking at, and the levels in the S&P that we've got our eye on. Be sure to check in at the end of the day with Scott and the T3 Live team for the daily recap.